Good afternoon, ladies and gentlemen. Welcome to today's webinar, Responsible Investing in ESG Engagement Standards. My name is Michelle and I'm part of the team here at Capital Markets Malaysia. Today's webinar is hosted by the Sustainable Investment Platform, which is a collaboration between Capital Markets Malaysia and the Institutional Investors Council of Malaysia. Our webinar today is part of a series of engagement the SIP has put together to support asset managers and asset owners to provide sustainable investment options. Today's session is the second part of the best practices in responsible investing. We had a webinar on proxy voting yesterday. Today's session is for an hour on the best practices in ESG standards by PRI and QAP. Now, I would like to welcome our first two speakers from PRI. We have Paul Chandler and Chloe Horn joining us from Amsterdam and London. It's only a 40-minute session and we would like to welcome as many questions as possible. We want to make it as interactive as we can. There is a Q&A tab at the bottom of your screen. You can click on the button and type in your questions. We will be taking your questions at the end of the session. Without taking more time, I'll hand over this session to Paul and Chloe. The floor is yours, Paul.
Thank you very much, Michelle, and good afternoon, everybody. Thank you very much for joining today's session and also to the organisers for inviting us to speak. My name is Paul Chandler and I'm the Director of Stewardship at the PRI. I'm responsible for overseeing the work we do on stewardship as an organisation. I'm going to be spending the next couple of minutes just briefly introducing our session. I'll introduce the PRI for anyone who may not know us. And then we'll talk a little bit about how we think about stewardship at the PRI. So if we jump to the next slides. After I'm finished introducing stewardship, we will then talk about engagement in more depth, and I'll hand over to my colleague, Chloe Horn, who will take you through that part of the session. So, about the PRI. The PRI was established in 2006 by the then UN Secretary General, Kofi Annan. It is an international network of signatories who sign up to 6 principles for responsible investment. And those signatories commit to understanding and addressing the implications of environmental, social, and governance issues, or ESG issues, in investment practices and ownership decisions. We have 2 UN partner organizations who are the United Nations Environment Programme's Finance Initiative, as well as the UN Global Compact. We have now more than 4,000 signatories and more than $100 trillion in assets under management. The PRI has 1 mission and 6 principles. The mission, which I'll leave you to read on your own, is centered around the creation of an economically efficient and sustainable global financial system. And critical to that is an understanding that we require a sustainable financial system in order to generate long-term returns for clients and beneficiaries. There are, like I said, 6 principles around the incorporation of ESG and how investors go about putting that into their organization, as well as around transparency. But most critical to today's discussion is principle 2, which says we will be active owners and incorporate ESG issues into our ownership policies and practices. Like I said, the PRI is a growing organization, and in the last year, we've just ticked over 4,000 signatories globally. And you can see in this graph the proportion of those that are asset owners versus those that are other signatories, including asset managers and service providers. So stewardship. The PRI has been working on stewardship for a number of years, but in the last couple of years, we've developed a dedicated program to help signatories go about implementing their role as active owners or stewards under Principle 2. In terms of what we mean by stewardship, PRI defines stewardship as the use of influence by institutional investors to maximize the overall long-term value, including the value of common economic, social, and environmental assets on which returns and client and beneficiary interests depend. So you will see there again the links to our mission in terms of the importance of protecting those common assets on which overall performance of investments rely. But key in this sentence is about the use of influence. So we distinguish this from investment decision making and say it is just about how you are as an investor using your influence over others. And there are a number of means by which investors can go about being stewards. And we list them on the next slide. There are two broad categories here. So firstly, there is how investors use their influence with current or potential investees, typically issuers like companies, sometimes sovereign bond issuers. But what this means is it's about engagement with those issuers across all asset classes. It includes, for listed equity, voting at shareholder meetings and filing of shareholder resolutions where that is available to you in your markets. It does also include things like the direct roles investors may have on investee boards, which is relevant, of course, to private markets, and roles on board committees, which is something that happens in some markets, for example, in the Nordics, where investors have a more direct role on the nomination committee. In rare circumstances, it can also include litigation, where investors as owners of shares in companies can litigate if they believe a board or company has materially failed to uphold its duty to shareholders. There's also the use of influence with non-issuer stakeholders. And this is things like engagement with standard setters and other stakeholders. So public policy engagement, where you're engaging with governments and regulators. There is also contributions investors may make to public goods, such as research. And an example of this is the Transition Pathway Initiative, an asset owner-led organization that helps everybody, including asset owners, understand how corporates are responding and managing climate change. There's also contributions to public discourse. So, for example, making a comment in the media in support of action that may further your ESG objectives. And lastly, the work that you as investors do to negotiate and monitor and engage with service providers. And that, if you're an asset owner, could include an external manager. So your role in engaging them on the stewardship they do, but also could include your work engaging with proxy advisors or engagement overlay providers. So the PRI works to support signatory stewardship efforts in a number of ways. We provide guidance and support on leading stewardship practice, and we'll talk a little bit more about that later in the session. We facilitate collaborative engagements, and again, we'll hear a bit more about that shortly. We convene investors through the PRI's collaboration platform, which is a signatory-only tool that allows you to share and post information about initiatives that you are running or find out about others and get involved in initiatives led by your fellow investors. We also work to address system barriers or structural barriers to effective stewardship. So things like helping regulators put in place good practice stewardship codes, or providing clarity to investors around the legal limits of stewardship. And finally, we also support investors during the annual AGM season, particularly the AGM season relevant to the Northern Hemisphere, which is in sort of the May to June period. So at this stage, I will pass over to my colleague, Chloe Horn, who will talk you through what we mean and what we do on investor engagement. Chloe, over to you.
Thanks very much, Paul, and thank you to everyone for having us today. I'm really pleased to be here. My name is Chloe Horn, and I'm a stewardship specialist at the Principles for Responsible Investment, where I focus on collaborative engagements and other stewardship activities, such as voting. Today, I will be speaking to you about investor engagement, both individually and collaboratively, and cover the value of conducting engagements, as well as some good practice foundations I'll also talk you through some of the PRI's previous and current work on engagements and some opportunities to get involved before handing back over to Paul to talk about the evolution in stewardship that's taken place over the last few years. But before we get started, I wanted to go back to how Paul defined stewardship, and he mentions using investor influence to change a practice or an outcome. And I really wanted to highlight that whilst engagement and stewardship are often referred to interchangeably, engagement is really a key tool, but just one of many tools available to stewards. And as you can see, we define engagement as an act of an investor communicating with decision makers, such as investee companies, but also other groups like policymakers and standard setters. Looking at the bigger picture and an overall responsible investment approach, stewardship, including engagement and voting, as well as ESG incorporation, can't be looked at in isolation, as they can really be used as complementary strategies that feed into one another. So for example, investors can use insights that they gather from their engagement with companies to support their investment decisions. And even within stewardship, different activities can complement one another. So research that's carried out through engagement can also be used to help support voting decisions at a company annual general meeting. But going back to engagement specifically and looking at engagement with investee companies, a lot of this goes without saying, and I think is evident to investors, but there are a number of reasons why investors should carry out engagement and seek improvements over the long-term horizon. So firstly, there's a growing evidence, a lot of which can be found on the PRI website, including academic research, that shows that addressing ESG factors within companies contributes to the relative outperformance of those companies, and that strengthened ESG performance can contribute to long-term growth. But even looking beyond outperformance of individual companies and instead at the performance of an investor's overall portfolio, there's evidence to show that engagement can influence this type of performance as well, which is really important for universal owners or those investors who are large and diversified to the extent that they essentially own a chunk of the world. And just to pull out one more example, on regulation, we see policymakers and standard setters increasingly encouraging investors to take an active role in influencing investee companies. And I'd be remiss if I didn't mention the Malaysian Stewardship Code as well, which sets out explicit principles on the disclosure of stewardship voting policies, and it also looks at the monitoring and engaging of investee companies. But taking this a step further and looking at investor practice, I think it's fair to say that best practice would dictate developing a stewardship policy in line with things like local regulation and codes and beneficiary preference to have a consistent and coherent approach to stewardship. And at a high level, you'd expect a policy to cover an investor's stewardship objectives or engagement objectives, the stewardship tools the organization uses, including the tools that Paul covered earlier in the presentation, the role of collaboration as well, and when this might be used, how inside information and conflicts of interest are managed, and how stewardship activities link to investment decision making, like I mentioned earlier. But digging into this a bit more and looking at the key components, I won't go into the specifics here, but to highlight two in particular, methods of engagement and escalation strategies. I think it's really crucial that investors outline the ways in which they plan to engage with investees, including the form of dialogue, whether that's writing a letter or holding a meeting, and also the recipient of that dialogue is also really important to think about, whether that's the board or the CEO or technical specialists within an organization that can really talk about the details of a sustainability issue. And one other thing we've really been encouraging at the PRI is how investors plan to escalate engagements if they're unsuccessful for whatever reason. So if a company is unresponsive, how will you consider other tools such as filing a shareholder proposal or public discourse or litigation if that's the most appropriate next step. Moving from the development of a policy to putting this into practice, again, I won't go into too much detail here, and this picture you can see is an extract of a guide we have on our PRI website, which goes into the details of how to conduct an engagement. But to summarize, investors really need to ensure that they're sufficiently prepared to engage, which includes carrying out extensive research on the issue and the company, and planning key objectives and milestones. And again, looking at escalation, how do you plan to escalate concerns if those milestones are not met? Investors need to think about how they plan to deliver the dialogue and ensure it's a meaningful interaction for both parties. And I think what's really key here again is sometimes that investor affirmation. So it's showing the company that you're interested in the long-term performance of the company and really evidencing why the issue is important for that company or important to an investor's overall portfolio. And like I mentioned as well, investors need to consider how they'll take further measures to escalate engagement where those milestones are not met. And lastly, this goes without saying, but as the engagement concludes, it's important that investors determine whether the companies have fulfilled investor expectations by assessing the objectives established at the beginning of the initiative and measuring progress. And I mean, Paul will talk about this in a bit more detail later on in the presentation, but I think it's important that investors are considering how they are measuring their engagement, and not just on activity metrics such as how many conversations you've had with a company, but how that company has actually progressed on a specific issue, or how you were seeing outcomes in the real world. And of course, a lot of these policies and strategies will vary significantly. There's no one-size-fits-all approach, and it will vary depending on things like the asset class it's covering or the type of investor, whether they're an asset owner or an investment manager. And I think it's really important that we acknowledge this, because we really want to encourage investors to consider how stewardship fits within these different categories, and that engagement isn't just limited to listed equity investors. For instance, for fixed income investors, and that's both at the corporate and sovereign debt level, we know they're not necessarily in the same position as shareholders. They don't have formal shareholder rights and like being able to vote at annual general meetings, but they do have clearly defined legal rights and the ability to interact with issuers to address how they behave and operate, with a focus perhaps more on debt origination and reissuance. And looking at private market investors, who are often in a unique position when it comes to stewardship, because they often have controlling interests of their investments and positions on portfolio company boards, and they can use this direct form of influence, again, that Paul mentioned earlier, to meet their stewardship obligations. And just to pull out one more, looking at externally managed assets, and we see that stewardship activities are often carried out by third-party managers, but the client still has an important role to play in using their influence across the investment chain by working stewardship considerations into things like negotiation, selection, appointment, and monitoring of those third-party managers. So one area I wanted to highlight in particular was collaboration and how that plays a role in engagement. So I'll spend a few moments talking specifically about collaborative engagements, the value added of joining forces, and some opportunities for investors to get involved. So it's set out in our principles, which is principle 5 of the Principles for Responsible Investment. We see collaboration as a key component of being a responsible investor, and really crucial as well for shaping those real pressing sustainability outcomes that often rely on action from more than one individual. And we know it's not necessarily the solution in each stewardship activity, but collaborative engagements offer a range of benefits. And just to highlight a few, collaboration can help investors to draw on the perspectives of expertise of different organizations and to take a more nuanced approach to engagement. And we see that this is really important in our collaborative engagements. And I think it's really important to think about collaboration beyond just investors, but thinking about other groups as well, such as experts, academics, NGOs, affected stakeholders, to really get that broader perspective when it comes to engagement. And collaboration can also be a really efficient way of engagement because it potentially avoids duplication of efforts of different investors. It feels very inefficient if you have multiple investors engaging with the company on the same topic. And I think that gives sometimes the company and different groups some confusion about the approach they should be taking. And sometimes having an aligned approach is a lot clearer. It also allows investors to share the cost of research and engagement. And it also, which we think is really crucial, it offers those smaller and resource-constrained investors the ability to get a seat at the table that they wouldn't necessarily have on their own, and the ability to contribute to high-impact initiatives. And as Paul mentioned earlier, one of our roles at the PRI within our stewardship team is convening signatories and facilitating this kind of collaboration. And we have a number of opportunities available for investors. So a new program for us, which I'm currently working on, is an upcoming collaborative initiative on social issues. And this will essentially be a global platform where investors can engage with companies on human rights and social topics that are most severe at each company. And since this is a new initiative, the details such as the companies we plan to engage with are still being ironed out, but we hope to provide some more information to investors at the end of next month and plan to launch the engagement next year. And we'd really welcome participation from investors across the globe, including in Asia and Malaysia. So please do reach out to me if you're interested in this. Something we've been working on for a while now is nature and deforestation issues. And we previously ran 2 engagements. So one on palm oil in Southeast Asia, which Rizal from COP will cover a little bit more later on in the session, and another on cattle and soy in Latin America. And going forwards, we've decided to launch a broader engagement which encompasses all of those to focus on nature and land use issues. And this will be launched again in the coming months. And lastly, and I think this will be familiar to a lot of you, for a number of years, we've coordinated Climate Action 100 Plus, or CA 100 Plus, with a number of other investor network groups, including AIGCC, so the Asia Investor Group on Climate Change. And this initiative focuses on ensuring the world's largest corporate greenhouse gas emitters take the necessary action on climate change. And they have 3 expectations across governance frameworks and board accountability of climate change risk, action on reducing greenhouse gas emissions consistent with the Paris Agreement, and enhanced corporate disclosure. And about 1/3 of spaces are open to new investors, and especially investors based in Asia and in emerging markets. Lastly, I wanted to highlight that there are so many initiatives out there to get involved in, and a lot of these aren't led or co-led by the Principles for Responsible Investment. But what we do have is an online platform that Paul mentioned earlier, which is accessible to PRI signatories, where you can find a variety of initiatives on ESG issues that you can get involved in and collaborate with other investors. So it's a really great tool to be able to find collaborative engagements, but also to engage on the platform itself. And you can see in the pictures, you have the ability to share files on the platform, such as investor statements that may need comments from investors. You can share just general updates, and you can send messages to other members of the group. And lots of initiatives are up there already, including the PRI initiatives that I spoke about earlier. But if this is of interest to you, you can find out more on the PRI website, and we have some information at the end of this slide as well, which I think will be shared with you afterwards. But that's it from me. But again, thank you very much for having us today. And I will hand back over to Paul for the last part of our presentation.
Thank you very much, Chloe, and for taking us through that excellent presentation on engagement. For the last part of the session that we'll be running today, before we hand over to Rizal, I wanted to talk to everybody about the work we're doing on a program called Active Ownership 2.0. And this is setting out some ideas we hope will be useful for signatories or for investors thinking about the future of stewardship. And this program is driven by something that Chloe has already touched on, and that is around the importance of addressing systemic sustainability issues. We know, of course, investment risk is made up of the idiosyncratic or company-specific risk that each issuer faces, but it's also affected by or also subject to systemic risks. And those are kind of risks that affect the whole market, the whole portfolio, the whole economy. And it doesn't matter how good your diversification strategy is, you are unlikely to be able to diversify completely around those risks. Examples of this are things like climate change, which of course is a large and pressing issue. So in terms of active ownership 2.0, if we jump to the next slide, we set this out as a framework for the more ambitious stewardship we think is necessary if we are to deliver against beneficiary interests and improve the sustainability and resilience of the financial system. It really is about having investors using their influence to try and shape the way the whole system works in order to address these systemic issues and drive positive sustainability outcomes. There are three components of active ownership 2.0. And we set them out in this slide, and I'll talk about them a bit more detail on the following slide. But we have, firstly, the role of investors in being direct stewards, the importance of collaboration, and the role investors have in stewarding the market overall. And each of these three components is there to contribute to this broader goal of addressing systemic sustainability risks and driving positive outcomes. So to break that down in a bit more depth, in terms of direct stewardship, we talked about this earlier on. This is things like engagement that you do with issuers, voting if you're in listed equity. It includes escalation strategies. And we've seen an example of that earlier this year at ExxonMobil, where a shareholder nominated 4 new directors to the board of ExxonMobil, and 3 of them were elected by shareholders. And that followed many years of unsuccessful engagement. So that is one component. The second thing we articulate here is the importance of collaboration. And this is really critical for stewardship overall. Chloe just mentioned it in the context of engagement, but it's important because there is this free rider problem with stewardship. So that if you are doing good stewardship yourself, everybody else is benefiting from that. And similarly, if you choose not to, then you still benefit from the good stewardship of others. So that's why we really do encourage collaboration as a means of pooling investor resources and tackling some of these issues in a way that everybody can contribute and everybody can benefit from that. So one method, of course, is collaborative engagement. We've heard about that now, and we'll hear again about it from Rizal shortly. But there's other means too. We can pool resources through external engagement overlay providers. We can fund joint research projects that help support the effectiveness of stewardship overall. And then the third pillar here is what we've termed, for the moment at least, market stewardship. And this is the idea that investors have a role in trying to shape the way the overall market, the overall economy works with respect to E, S, and G issues. So it includes activities such as policy engagement or engagement with standard setters or associations. And it could be, for example, the engagement you may do either individually or through a body like the Asian Investor Group on Climate Change to encourage phase out of the use of coal, or to encourage the establishment of carbon pricing. And in doing that, we hope that investors are contributing to the way the economy functions and raising the bar for all companies, all issuers, regardless of whether they're in your portfolio or not. In doing so, helping to really address those systemic issues. So I think it's really important to stress that this is not an either-or situation. We continue to need investors to go out there and engage companies and use your stewardship power to address risks that individual assets face. So if a company is facing sustainability risks, we think it's important that investors are out there using your influence to engage with management or the board and trying to address those risks at individual assets. We are saying, in addition to that, that good practice means also working to directly seek outcomes, real world change on systemic issues and on common goals. And that work that you do to protect public assets, such as a functioning environment or perhaps a society that is fair and therefore offers more people a chance to participate, we think doing that is fundamentally essential if we are to continue delivering solid returns to clients and beneficiaries going forward. So that draws us to the end of our presentation, and I'll pass back to Michelle, I think, to introduce Rizal shortly. I just wanted to conclude with this slide, and you can see here there's a number of links that you'll be able to click on once you get the slide deck afterwards, but you'll also find our contact details, along with the contact details of James Robertson, who is our head of Asia, excluding China and Japan, based in Hong Kong. And I'd also encourage you to visit the PRI website. The links are there, but you can also visit unpri.org/stewardship for a lot more information about all the topics we've talked about today. But for now, I'll pass back over to Michelle and look forward to answering questions in the Q&A later on.
Thank you. Thank you very much for that, Paul and Chloe. So if there's any questions for PRI, do type them in the Q&A box. Now, I would like to invite Rizal Muhammad Ali, the Vice President Responsible Investment from QUAP. Rizal will be presenting a case study by an institutional investor. So the screen is yours, Rizal.
Thanks, Michelle. I would like to start off with a question. Why do investors conduct shareholder engagements? For institutional investors, with our relatively large fund size and large shareholding in PLCs, coupled with our long-term investment horizon, we are in a good position to exert and influence our investing companies to promote good ESG practices. Furthermore, as predicted a few years ago, ESG has become mainstream, and now more institutional investors are pushing for the ESG agenda based on our own convictions that good ESG practices will assist our investments to obtain long-term sustainable returns. ESG is no longer seen as a hindrance or limitation to investment opportunities, but it's rather seen as a tool to manage reputational and financial risk. Based on this, institutional investors have been increasing our engagement activities. This is conducted both individually and collectively, as touched by Paul earlier. It is important that institutional investors have a structured approach to shareholder engagements, including at pre- and post-engagement stages. For pre-engagement, I feel that it is helpful to set the basis for the selection of the companies and avoid random selection. For example, the basis may include criteria such as poor ESG ratings as provided by rating providers, or internal ratings, whereby for institutions like QUAP, who has our own internal rating, we use the result to identify companies to engage with. Secondly, it may include companies with ESG red flags or controversies. The source of concern may be negative press report or ESG-related actions taken against the companies. At this point, I would like to emphasize that it is important to engage with the companies as soon as there are grounds for concern, rather than wait for the issue or charges to be proven. At QUAP, we normally engage with the investing companies immediately, and shareholder engagements were conducted within days of the news. The third basis of selection may be industry focus, whereby, for example, you choose a few companies from the same industry to engage in that quarter. This may include industries you are heavily invested in based on your investment portfolio, or simply industries you are considering to invest in the near future. This will enable you to do peer benchmarking of the companies and also have more practical insight on the best industry practice for that specific industry. What are the key challenges in adopting ESG for the players in the industry? And finally, what is the stage of ESG adoption? I would like to further share our experience that shareholder engagement, which ideally should be attended by the senior management and reps from various departments, including risk management, research, equity, it might not provide sufficient time for you to really deep dive into ESG specific issues, largely because during the discussion, you will also touch on corporate matters, including strategic plans and financial performance. As such, at QUAP, in addition to senior management engagements, we also conduct ESG specific engagements, which is focused purely on ESG related matters. The other main area of engagement by institutional investors is active participation at AGMs and EGMs. We can see increasing participations by Malaysian institutional investors at AGMs and EGMs, whereby they post questions on the resolutions and raise ESG concerns, which are then broadcasted on the big screen, not just for our own information, but also for the benefit of all shareholders in the hall, and also for the investing companies to provide their replies to the queries. This applies to both physical AGMs, and I'm pleased to say that even during this lockdown period, it was also projected when we conduct AGMs online. In addition, institutional investors can also upload our voting guidelines on our website. This will provide clarity to the investing companies on what is our voting criteria. And this sets clear our expectations, whereby we will vote against resolutions that does not meet our ESG expectations as disclosed in the ESG guidelines. Next, I will touch on the effect of the pandemic on our shareholder activism. The pandemic has showed to us the importance of ESG and also how poor ESG practices has exposed the risk in our investments. For example, companies with poor social practices, such as cramped living quarters for their staff, were exposed to pandemic clusters. This led to stop work order, sometimes for a prolonged period, thus affecting the supply chain. This opened the eyes to how much more devastating the impact of climate change will be. In short, the pandemic has exposed and showed that institutional investors need to focus on our engagement and increase our engagement activities so that we are able to manage financial and reputational risk. While governors have always and will continue to be given focus on, there are now more emphasis on the environmental pillar, largely due to better awareness on the impact of climate change, and with more countries and organizations making time-bound climate change-related pledges, and the focus on the social pillar was well accelerated due to the pandemic. I would now touch on the benefits of joint engagements. In addition to individual engagements, which I touched on earlier, institutional investors in Malaysia also take part in joint engagements organized by Institutional Investors Council of Malaysia. The main benefit of such joint engagement is collectively, the shareholding held by institutional investors are much higher. For example, as a case study, during one of our joint engagements this month in October of this year, our collective shareholding just from 3 institutional investors was almost 80%. Just imagine the strong message we would have collectively conveyed to the investing company's board and senior management, whereby we expect them to abide by our recommendations and based on our common stance and expectations pertaining to ESG. On that note, I would like to highlight that while to some extent, institutional investors may have differing views on governance, for example, minimum age of directors, percentage of female representation on companies' boards, it is safe to say that no institutional investors would want their funds to be invested in companies that practice poor labor practices and activities that are harmful to the environment. So on that note, to some extent, it is not hard to send a common message to the investing companies, setting clear expectations and which will carry significant weight and influence. In addition to joint engagements via IIC, We have also participated in joint engagements via PRI's working group, such as PRI working group on palm oil, whereby we jointly conducted engagements with the PRI experts and selected signatories with the Malaysian palm oil companies a few years back. I feel that the added benefit and takeaways the foreign delegates and PRI reps obtained from the session is it enabled them to have better insight on the unique operating environment Malaysian palm oil companies operate in, including their high dependency on foreign neighbors. Hopefully, this will enable the foreign investors, analysts, and subject matter experts to make better informed judgments in their analyst reports and investment decision making. The final category of engagement the institutional investors can participate in are engagements with the relevant government ministries and regulators. I think Paul also touched on this earlier. I would like to say that in Malaysia, applying this to the local scenario, institutional investors have nominated their reps to sit in task force and committees organized by the government and regulators. These include areas such as formulating and updating ESG-related guidelines and framework. And in 2021, both EPF and QAP jointly engaged with the Ministry of International Trade to discuss on labor issues in Malaysia. Finally, I would like to touch on the rooms for improvements. There has certainly been significant increase in shareholder engagements by institutional investors in the last 2 years. There are 3 Malaysian institutional investors who are PRI signatories to date, and at least for QAP, the drive for this is not merely a box-ticking exercise to meet PRI's recommendations. Rather, they are due to our own convictions, as I had touched on earlier. However, the tools, the guidance, the recommendations provided by PRI, which I have mentioned earlier, are certainly useful for institutional investors like QAP. And the PRI signatories, we are indeed privileged to be able to benchmark our international practices against a globally acceptable standard. Moving forward, I think the momentum to engage will ramp up further, boosted by, for example, the government's ongoing ESG-related initiatives pertaining to GLCs and sovereign wealth funds in Malaysia. One area which I think is a low-hanging fruit is for institutional investors to improve on our transparency, and we should disclose our shareholder engagement activities on our annual report and website. This will help disseminate the information and push for our investing companies to be aware that ESG is an area that we look into closely, and we will continue to do so. That ends my presentation. Thank you.
Thank you, Rizal. All right, so that was a very comprehensive presentation. Can we have Paul and Chloe on as well? So we have two different questions actually. The first one is, how would you balance collaborative engagements, large investors versus minority shareholders' interests, i.e. the minority shareholders may not agree to the proposals from collaborative movements? So I believe this question would be for PRI. And the next, do you want to answer this first and then we go ahead with the next question?
Yeah, sure. So thank you to the questioner for the question. It is an interesting one. I think there's a couple of things to say. Firstly, even most collaborative engagement groups will still be a minority of a company's outstanding capital. So it's unlikely that you'd see a block shareholder, a family owner, a large parent company participating in a collaborative engagement. That wouldn't typically not happen. So it is still likely to be a group of minority shareholders who are pushing for a particular improvement in disclosure or improvement in practice by a company. Of course, investors are not one body, and there will be disagreements between investors on what good practice looks like for a particular issuer, and that's fine. I think there's a role for investors in having different views, and we don't want to enforce a one way of doing things. What I would say though is, if an investor, a minority investor that's not part of a collaborative engagement, wanted to express a different view, there'd be 2 ways to do that. The first would be to try and engage with the collaborative group of investors, the collaborative engagement, and offer some input and views and support to that group, even if you're not going to formally join the initiative. And the other means, of course, is just to engage with the company. There's nothing to say you can't offer a different view to a corporate board. Of course, I think investors will be more effective in advancing practice on ESG if they are speaking from the same message or the same hymn sheet, I guess, as we would say. However, at the end of the day, corporate boards and management have a responsibility to balance different viewpoints and take the approach that they think is best in the best interest of shareholders overall. So I would say, it's not a massive issue, but if you do disagree with what an engagement group is doing, do reach out and do get in touch with the organization leading that work so that we can try and understand and improve the overall initiative.
Okay, thank you for that, Paul.
Hi, Michelle. If I can add to that.
Yes, sure.
Yeah,
go ahead.
from an institutional investor's perspective, there is also a complementary role that institutional investors can play for the benefit of the minority shareholders, largely because analyzing AGM's resolutions takes a lot of time, a lot of manpower, and it's only institutional investors that can dedicate a team to look into it. So from my experience in raising questions at AGMs, EGMs, while as what Paul mentioned, it doesn't necessarily result in the resolution being rejected, not being approved, but at least we can highlight to the minority shareholders the concerns that we have discovered based on our analysis of the resolutions. So that is where sometimes I would like to even call it creating of awareness on what are the areas the minority shareholders should also look into. Thank you.
Thank you, Rizal. Okay, and the next question is, which is more effective, government's interventions or market regulations by the investors?
This is the question for the 21st century, I think. Unfortunately for the question, my answer is that it depends. There is no one right way of addressing a particular issue. I would say, though, that over the last few decades, we have seen perhaps an over-reliance on the power of markets to correct externalities in the economic system. An assumption that by doing good, companies will do better, and therefore if we are encouraging companies to do good, they will do better, and that will address those externalities. And what we know about the state of our economic, environmental, and social systems is that they are actually in, I don't think it's an underestimate to say, great peril at the moment. So if we are to address some of these issues in a way that will not risk catastrophic effects on our economy and investment returns, then ultimately market intervention by government is going to be needed in order to address those issues. It is just going to be much more effective and efficient for investors to encourage governments to raise the bar for everybody than it is for investors to go company by company and asking those companies to individually align with investors' expectation on a given issue. However, I think that's not always going to be the case, and there will be opportunities for investors still to engage with issuers and help them use their influence as companies that go, for example, down the value chain. If we're talking about, I think Rizal mentioned labor issues, and that you might have a good set of regulation in one particular country to cover labor issues, but if a company with a long supply chain is operating in another country without those same good quality labor issues, labor rules, then engaging with a company to enforce or encourage its value chain to align with those high standards is going to be an effective way of dealing with that. And similarly, you might find situations where there is political deadlock and investors contributing to the dialogue with companies can help to change that. So I hope that answers the question a little bit. I would say we need both, but we should not over rely on markets and in sort of good practice ESG as the means of addressing what are actually quite critical issues.
Okay, thank you. That was the only 2 questions we have. Are there any more questions? Okay, there's one more that just came in. How should we measure the effectiveness of corporate engagement activities? So how should we measure the effectiveness? I think this would be for Paul, right?
Well, I see Rizal has unmuted his microphone, so maybe he would like to have a stab at this one first.
Sure.
I was hoping to add on to Paul's point. Yeah, but for Co-op, how we monitor is, for example, when we look at the board composition, we might have made some recommendations and we can see gradual improvement over the stipulated timeline. For example, the company might have no female reps on the board, but over time they increase the number of female reps within the timeline as the AGM, throughout subsequent AGMs. We have also seen our recommendations on better labor practices being addressed to. We've seen better measurement of carbon emission. So, a lot of the ESG practices cannot be addressed overnight. So, you can't expect to engage with the company and for them to address all the issues at the same time. So it's tied up with my earlier point that shareholder activism takes a lot of manpower, takes a lot of time. Hence, you need to have a structured approach and monitor the company's adoption of your recommendations over the agreed timeline. Even though I mentioned earlier that institutional investors have a long-term investment horizon, but if we feel that the company is not addressing our recommendations within the agreed timeline, then we might have to take a more drastic action, as Paul had touched on his slides earlier. Thank you.
Okay, Paul, would you like to add?
I would agree fully with that. I think it's right that we need more structure in the way dialogues are carried out. And that structure gives you a way to assess the success of engagement, because if you are setting an objective beforehand, you can measure whether the company that you're engaging with, if you're engaging a company, has met that objective. You're not ever going to know, unlikely, you'll know whether the company is taking that action only because of your engagement. It may be because of your engagement and also pressure they've received from other stakeholders. But that is, I think, just a price we have to live with in terms of the fact that, this is asking companies to change, it asking other issuers and other stakeholders to change, and it's going to be difficult to track the exact causality. But we can look at how things have changed and whether, those objectives that you set beforehand have been met. I think on the broader question of systemic issues, ultimately the only measure that's relevant is whether we are addressing those systemic issues at a global level. So it is good that we're seeing progress on how companies are managing climate change. For example, we are seeing companies setting targets to reduce their emissions to net zero by 2050. But until we start seeing emissions falling at a global level, we are still going to be facing these systemic risks.
Okay. So I think that's about it. We don't have any more questions. Any more questions, guys? You could just type in the Q&A box. We still have about 5 more minutes before we end. Okay. All right. Otherwise, we will have the presentations uploaded on our website together with the speakers' contact details if you'd like to reach out to them. I guess on that note, I would like to thank Paul, Chloe, and Rizal for being part of this session. And thank you everyone for joining us. We hope to see you in our upcoming engagements. Thanks everyone. Bye.
Thank you very much.
Thank you
Very much. Take care.